All right, hello everybody, and welcome to the paper session number 10 about green financing. My name is Kerstin Lopatta. I'm from the University of Hamburg, and I have the honor to chair this session. The first paper we are hearing here today is or has the title, Do Investors Care About Impact? And the authors of the paper are Florian Heeb, Julian, Kölbel, Falko, Paetzold, and Stefan Zeisberger. Yeah, Florian, the floor is yours. You have 30 minutes, and Florian wants to go straight to his presentation. So that means you have 20 minutes for the presentation, and then we add the Q&A for 10 minutes at the end.
Good, thanks, Kerstin, and welcome everybody. I hope it works with my screen sharing. Good, looks good. Good, then let's get started. So welcome to the presentation on our project, Do Investors Care About Impact? As mentioned, this is a joint work with Julian Kölbel, Falko, Paetzold, and Stefan Zeisberger. So sustainable investing is increasingly seen as a mechanism to curb negative externalities. And this is featured prominently in a series of recent theoretical working papers. And at the same time, we have plenty of empirical evidence now that investors have often pro-social preferences, and in some cases are even willing to have an explicit willingness to pay for sustainability. Now, the before mentioned theoretical models all assume in some way that investors, pro-social investors, are consequentialist. So that means that investors deliberately trade off financial wealth with impact. And impact we define here as any positive externality of an investment. However, from literature on charitable giving, we know that donors often neglect how much impact their donations have. So, meaning that utility comes from more from the act of giving than rather from the impact a donation has on the real world. And this guides us our question. So, do pro-social investors care about their impact? Or put it more in a formal research question, how does investors' willingness to pay for sustainable investment products respond to the impact of these products? And to put it a bit illustrative, so if an investor is willing to pay $1 to save 1 tree, is an investor also willing to pay $10 to saving 10 trees? We approach this question with a pre-registered frame field experiment. And in the experiment, main experiment, we measure investors' willingness to pay for an investment with impact compared to a financially equivalent investment without impact. And what we do to elicit sensitivity, we vary the amount of impact of the sustainable investment, so the investment with impact, between subjects. So our independent variable is impact, which we implement as tons of CO2 emissions saved with the investment. And our dependent variable is the willingness to pay for the sustainable investment, which we measure in terms of upfront fees investors are willing to pay to receive the sustainable investment. All decisions are incentivized and consequential. So we do real investments. So we randomly select 10 participants, and for each of them we make a €1,000 investment over 1 year that later gets paid out to them. And also the impact is real. So we realize all the CO2, the climate impact of the selected participants with investing in carbon offsetting projects. So let's have a more detailed look at the methodology. So basically, investors receive an information on 2 funds they can compare. As mentioned before, on the left you see Fund A, which has an impact, and on the right, Fund B, which does not have a climate impact. Both investments are financially equivalent, so same asset class, same return, same risk category, but they differ, of course, in impact. So here, Fund A, it's the low impact treatment we have, saves half a ton of CO2 emissions with €1,000 investment. And in order to make sure that investors really understand what half a ton of CO2 is, we also translate that in more intuitively comprehensible units. For example, here we say half a ton of CO2 corresponds to planting 3 trees. It corresponds to flying 1,500 kilometers by train, or to the average emission caused by US citizen in 25 days. Also, you can see this on the bottom right. In order to avoid experimental demand effect, we frame sustainable investing in an ambiguous way. So not making clear whether we as an experimenter think that choosing the sustainable fund is really beneficial for a climate or rather a distraction. To have a look on the flow of the experiments, we start with a series of instructions, making sure that investors understand the whole procedure. And then we divide investors into two treatment groups, a high impact group and a low impact group. So in the high impact group, investors decide between investments saving 0 tons and 5 tons of CO2. In the low impact group, it's 0 tons and 0.5 tons. So between the two impact treatments, we have a difference of a factor of 10 in the impact sustainable investment causes. After investors receive the information on investments, as you have seen it before, we elicit their willingness to pay for sustainable investing. So Fund A versus Fund B. We measure, as mentioned before, we measure the willingness to pay in fees. Investors are willing to pay to receive the sustainable investment. We here use a bisection method, which allows us in 7 decision steps to measure investors' willingness to pay with a precision of 0.25 euros. And we use a Becker growth Marshak mechanism in order to properly incentivize all investment decisions. And after eliciting in willingness to pay, we have a post-experimental survey where we elicit a series of control variables. Some words on participants. So we work with a sample of 500 plus private investors, which all are members of the VEB, which is a Dutch interest group of retail investors. So these are experienced and interested investors. They're familiar with making investment decisions, and they do not have a specific focus on sustainability. If you look at the demographics in the small table here, so the sample is rather old, rather male, and income and net worth are somewhat above the average, the Dutch average. So let's have a look at the result. So our main finding is that investors' willingness to pay does not respond to the level of impact of the investments they choose. So first of all, we show that investors do have a substantial willingness to pay for investments with impact. So for both the low impact and the high impact treatment, we do measure a high level of willingness to pay, a substantial willingness to pay. But we also show that the amount of impact does not have a significant effect on the willingness to pay. So there is no significant difference between the willingness to pay in the low impact, in the high impact treatment, given that we have a factor of 10 difference in the impact of the investments. And if we then calculate how much investors are willing to pay for each unit of impact, this leads to highly inconsistent valuations with clearly significant differences in investors' willingness to pay per unit of impact. So we ask, do investors care about impact? From what we see here, we have to say it doesn't look too much like this. So what I would like to do next is to present you a few robustness checks and then go more into possible explanations for the observed behavior. So firstly, we want to test whether our experimental setup actually can pick up sensitivity, and that the observed insensitivity is not merely an artifact of the experimental methodology we use. So we repeated our entire experiment with the same set of investors or with the same target population. But instead of differences in the impact of investments, we use differences in the past return of investments. So again, we have a high and a low treatment. The low return treatment, there is one fund with a 0.5% advantage, and in the high impact treatment, there is a fund with a 5% advantage. And again, we measure investors willing to pay to receive the fund with the higher advantage in each treatment. So, and here we see perfect sensitivity. So again, we have a factor of 10 between treatments in terms of outperformance, and investors' willingness to pay perfectly scales with past return, which you also would have expected from what we know from literature. So concluding, we can say it's rather unlikely that the results we see on impact are driven by our methodology. Then we also want to know, is impact information salient and comprehensible? So from what we see from our post-experimental survey, we have to say yes. So information is salient. 95% of investors can reproduce the exact level of impact of the investments after the experiment. And it also seems that information is comprehensible. As mentioned, we already have translated CO2 into a more comprehensible unit. But we also ask investors what they think, what the value of saving a ton CO2 is, and on average they estimate something like 100 euro per ton of CO2, which corresponds pretty well to current estimates on the social cost of carbon. And also, we in each treatment we ask investors how strongly they agree to the statement that the sustainable investment makes a meaningful contribution to fighting climate change. And we can show that in the high impact treatment, investors agree substantially more to this statement than in the low impact treatment. So investors seem to be able to differentiate even if they do not see the other treatment. So good, then we move to possible explanations. So we look at three explanations for the observed insensitivity. First, experience. So the insensitivity may simply be a question of experience. So investors are just not experienced with evaluating impact in investment context, and thus not be able to give kind of a sensitive valuation. Here we ask our dedicated impact investors who have arguably quite some experience in evaluating impact, are they sensitive to impact information? Then we look at the role of comparability. So are investors sensitive to impact when they can compare different sustainable investment options? So if they can evaluate impact information side by side. And lastly, we look at the role of emotions. So to what extent can emotional response or warm glow explain investors' choices? So starting with experience, here we work with a unique sample of dedicated impact investors, something like 125 of them. Now, we recruit the impact investors over University of Zurich's training programs for impact investors, over several dedicated networks of impact investors, and over the impact investing customer base of several private banks. So the characteristics of this sample, these are all high net worth or ultra high net worth investors. They're investors with experience in impact investing and a specific intent to have impact with their investments. If you look at demographic, this sample is clearly younger. There's a larger share of female investors, and of course, these investors are substantially have a higher income and are way wealthier than the Dutch investors. Now, what we see is that even for dedicated investors, we do not see sensitivity. So even dedicated investors are not, the willingness to pay of dedicated impact investors is not sensitive to the amount of impact. Again, we do not find any significant difference between the low impact and the high impact treatment, while we see a general high level of willingness to pay for both treatments. And again, this leads to strongly inconsistent valuations for each unit of CO2. So concluding, we can say experience seems not to be the problem. So just if normal investors gain experience over time, this won't solve the problem we see. So even if investors that have spent quite a while on doing impact investing are not sensitive. Then as next, we look at comparability. So here investors receive information on 3 funds at the same time. So they can compare to sustainable investing. So here fund B and C both have an impact. You see the amount of impact corresponds to the impact numbers we had before for the low and high impact treatment. And again, we have a similar experimental setup. So instructions, and then investors receive information on 3 funds, and then we elicit the willingness to pay for both sustainable investments consecutively. So fund A versus fund B, and for A versus C. And we also have a second range treatment. So in the slide before, you saw we have like 0.5 and 5 tons, introduce a low range where we have a very low impact fund. So investors can choose between the sustainable investment saving 0.05 tons of CO2 and 0.5 tons of CO2. And looking at the results of this experiment, we see that yes, comparability increases sensitivity to impact. So investors are willing to pay more for the sustainable investment saving more CO2 within each range. But the willingness to pay seems to be strongly dependent on the given choice set. So if we compare the results between the low impact range and the high impact range treatments, results look almost identical. So it seems that with comparability, investors have some degree of sensitivity, but this sensitivity seems to be completely determined by the given options, the given choice set of sustainable investments they have, and not at all by the absolute level of impacts these options offer. And lastly, let's have a look at the role of emotions. So the question is, I mean, we ask our question, is our investors' decision to invest sustainably mainly driven by emotional warm glow rather than utility derived from the real world consequences of their investment activity, which could explain the observed insensitivity. And first of all, we see that positive, we ask investors after experiment on how it feels to invest in a sustainable investment and measure the level of positive emotions they derive from choosing the sustainable investment option. And we can show that for both private and impact investors, the amount of positive emotions investors derive has a strong influence, is strongly correlated with investors' willingness to pay for the sustainable investment. Then we can also say, looking at the absolute level of positive emotions investors derive, on average, all investors derive a high level of positive emotions from sustainable investing, and there is no significant difference between the two impact treatment in the level of emotions. So choosing a sustainable investment seems to feel good irrespective of the impact of an investment. And in our view, this is very compatible with a warm glow or explanation of investors' willingness to pay for a sustainable investment. Now, to conclude, so there's 4 conclusions I would like to add. So first of all, we show that investors have a substantial willingness to pay for sustainable investments, but we also show that the willingness to pay does not respond to the absolute level of impact that investments offer. Thirdly, we show that willingness to pay responds with increased comparability, but is strongly affected by the choice set of sustainable investments given to an investor. And fourth, we conclude that our observations are most compatible with a warm glow explanation of investors' choice and of investors' willingness to pay for sustainability. This contributes to the existing literature in several ways. So first of all, on investor decisions and pro-social preference, we suggest a new view of pro-social investors as warm glow optimizers rather than real-world impact optimizers. And this also has implications for the current literature on asset pricing, these theoretical models I showed in the beginning. So our finding question the assumption of deliberate trade-offs between financial wealth and impact, and hint at that investors rather trade off financial wealth and warm glow, which has potentially strongly differentiating effects on asset pricing. And we also highlight the role of potentially endogenous choice sets investors make their decisions within. We think future research could address specifically the information asymmetries regarding impact between investors and financial institutions, and also how the incentives this creates, how asset managers and intermediaries market sustainable investing products to investors. It has our findings have a couple of implications, and I would like to stress. So we see it that it's in a market perspective, sustainable investing is likely to benefit asset managers and investors, but not necessarily the environment, if the demand for investment is mainly growing by warm glow or positive emotions and not directly by the impact of investments. So asset managers may have any incentives to sell light green products, so products with minimal environmental impact, but it just made the bar to be considered green by investors, and then may also have incentives to market them strategically, kind of aligning choice sets in order to position these light green products as kind of the best available options. We suggest a series of potential solutions. Mainly, kind of, we suggest that policymakers could promote the use of sustainability ratings as labels, as we already see kind of a trend in the current policy landscape. But given our finding, we think it's very important that regulators or policymakers ensure that such ratings and labels are really aligned with societal goals. So, for example, if a fund scores well in a climate label, policymakers should make sure that such a fund is then really aligned with reducing climate warming to 1.5 degrees Celsius. Good. With that, I would like to thank you for your attention. I'm looking forward to any questions.
Yeah, thank you so much, Florian. The first question we have already in the chat.
Good.
Can you see it? Or
yeah. So since your sample participants are investors in one organization, is there any bias, or is it possible that the results will be different if you get other institutional investors involved? Yeah, I mean, first of all, these are not institutional investors, they're private investors. Certainly, I mean, this on bias, this is a very specific group of investors, but we think it's a very representative group of investors for average investors rather than, you know, sustainably interested in investors. So while I think the overall sustainability preference of this entire group may differentiate from the entire population of, let's say, Dutch investors, because we have, you know, this differentiating treatment between, you know, high and low impact, I don't think it should affect the sensitivity in any way. Are there any more questions?
I would have a question if I can.
Oh yeah, please.
Step
yeah.
in.
Certainly.
So I think what really emerges from the paper is that, like, somehow this needs to change. Right? Somehow investors should indeed care about the impact of their green investment. And I mean, you propose already a solution with the usage of metrics in your implication slide, but I was wondering, since as far as I know you and I've already been working also on the topic, like, what do you think about these metrics? Because there is a lot of critique that they don't agree enough on the assessment of companies. I mean, that's partly true, but like also from some study that we did, we find that at least they agree in some cases. Like generally, what do you think about these metrics? And yeah.
I mean, that's a huge topic. I think kind of how good are current metrics to assess the impact of investments, and also to say, I mean, most ESG metrics don't try to measure real world impact. They might try to measure sustainability risks, but some do. I mean, there's increasingly amount of metrics that try to measure impact, and I think still there's a lot of issues to improve these metrics. But I think I think that's kind of the spot where policymakers could get more active, really ensuring that. And you see that in the current debate in the last days, there have been here in Switzerland huge debate on greenwashing. Some of the large banks making impact claims they cannot, you know, sustain. Just creating a landscape where impact claims are clear and then also clearly sustained. I think that really helps. And we see, like, increasingly regulators start to get active in the topics. I'm curious where that will lead. So there's another question in the chat. So, do you think positive emotions caused by sustainable investing could be related to reputational effects? If investors can manage to have impact, whatever be its amount, they can communicate it about and improve their reputation. Yeah, certainly that may be an explanation. I mean, so this goes in kind of a signaling direction. You know, is it kind of like external signaling, but maybe also internal signaling? I mean, just to say, this is purely an online experiment, which investors in no way can show kind of what they did to other investors and that are unlikely to. I mean, it was done during COVID, where everybody was at home, so there was not much room to discuss. So from the experimental setup, we don't expect to see a lot of reputation effect. Of course, we cannot exclude it. Just more qualitatively from impact investors, certainly. I mean, being part of this impact investing community is important for them. Kind of. So maybe it's not. It's kind of just another direction of this warm glow explanation. It gives you some emotional benefit, whether that's kind of internally to feel good or externally to feel as a good member of a certain community. It's hard to say, I would say. And then we have a third question. How much does the need for presenting reasoning to invest in a green project vary when the asset manager works for a closed private equity fund management versus a listed investment holding company or a financial institution? Need to think about this briefly. So, I mean, what I maybe can add, certainly there's a range of different different asset managers. I mean, if there's dedicated impact funds, that they certainly apply much more scrutiny to presenting their impact and really proving what they do. But in my experience, at the same time, there's there's some huge public equity funds that also have impact in the title, with very little emphasis on really, providing strong evidence for how they actually contribute to make the world a better place. And in my view, that's a problem, that we do not have clear methodologies how to assess real world impact of different financial products and comparing them, that investors can make informed decisions. For example, if you go into a concessionary small impact investing fund, how does that compare to a public equity impact ETF offered by large providers, given that they also have different levels of risk? So it's, I guess, practically it's really hard for investors also to make good decisions right now.
All right. Yeah, Florian, as there's no more questions from the audience, I may add something to the first question, because my understanding was that you said a little bit, how can we work against it? How can we work against this hurdle? Mm-hmm. Do you have maybe any explanation why that is the case? That they act like that?
What exactly?
For the first question, you answered already, right? So yeah. The question was, and you said, well, how can you work against it? That this hurdle they take is not there anymore. But what is the explanation for why do investors act like that?
So So the first question on investor sample,
yeah, why is there a hurdle for the investors? Why is that the case? Is there any explanation for that?
To receive impact information. Yes. Yeah. I mean, okay, yeah. I think it connects to this overall finding. I think very generally, I think what we show is that kind of emotional response is very important in investment decisions, and so investors rather have a look at product and see what kind of, if that elicits, green feelings. So investors may not necessarily have an incentive to dig down deeper. So if you go to your bank and you get offered a sustainable product, you actually have little incentive, asking more questions or starting out with deliberate, information search and comparing it to other products, because what can you gain? Because initially, if it's more about emotional response to choosing a green product, and if you get offered a green product that looks credible enough, then you already have kind of the maximum utility, I would say, you can get as an investor. And so I think that there kind of the role of legislation, kind of regulation could come in, but I think it's a tricky balance, not destroying the entire demand by saying it's all has no impact. But generally, I think that could be an important rule, kind of connecting this enormous demand for green and sustainable investing with real world impact? Because I think right now we cannot trust the financial markets will do this connection by themselves.
Yeah, thank you so much, Florian.
Welcome. And thanks for all the questions. Really interesting.
Yeah. So 30 minutes are over, so I have to hand over to our next presenter. So the next paper we are going to listen to is Biodiversity Finance. And Christoph, I hand over to you.
Thank you, Kerstin. I think it also ties in nicely with Florian's paper, where he looked at, of course, kind of the willingness to pay. My paper is on closing the gap between financing for biodiversity and biodiversity finance. Now, I will explain kind of why I see those two concepts relatively different and where the struggles are. Now, the presentation is very standard. I will give a short introduction, also who I am, the motivation to the research question methodology, the evaluation of the literature, the results, the summary, and kind of what are the action points, what can we take away from that, which is in some ways also the core of the paper. So I'm currently at Fudan University, where I'm also the director of the Green Finance and Development Center, and I'm a visiting faculty at Singapore Management University, and I was before a couple of years in Beijing, where I led the Green BRI Center. So biodiversity, it's a big topic. It's of course also a very big topic that this year with the CDB COP, there is a lot of discussion on, for the first time, to include the financial sector into the biodiversity conservation responsibility. Now, has been a lot of movement, a lot of discussions, but often with mixed results, I would say so far. Now, the background is quite obvious. We have this loss of biodiversity, and we had on the opening ceremony, we also had a speech on the loss of biodiversity, that 68% of our wild animals have disappeared over the last 40 years. So we definitely have a clear biodiversity loss. That leads to a biodiversity finance gap in order to protect biodiversity, which is estimated to be about $700 to $900 billion, so big numbers. What's really interesting, though, is that the global biodiversity flows from the private sector is just $9 billion. Now, that is, of course, extremely little and does not fit at all into our world where we want to be more green and where we want to accelerate green finance. So $9 billion, that is less than the bi-weekly revenues of Apple. So it's pretty much nothing. Now, kind of at the same time, we know that the biodiversity loss has a massive impact on biodiversity risk. I'm not going to explain this huge transmission channel framework that the NGFS published this year again. What they clearly showed is that the biodiversity loss has similarly physical risks and the transition risks, and that of course trickle down to the economy and onto the financial institutions, which kind of leads to similar risk as the climate risk. At the same time, we don't know so much about those in the financial sector. Now, kind of with kind of the loss of biodiversity, the lack of finance, at the same time, there's huge risks. There's kind of, in addition, coming this new request to the financial sector to become nature positive. Now, which is not even defined. Nevertheless, kind of this nature positive principle comes up more and more. So the motivation is there's a clear recognition of the biodiversity loss, the financing gap, and that there are risks, which we don't know exactly which risk. And there's kind of some hopes that we'll structure this nature positive finance. But obviously, we're seeing very, very little action and very, very little results. Now, that's clearly motivating my research question, and I'm kind of almost trying to intend a pun, because of course the research question is, why do financial institutions not close the gap between the recognition of the need to incorporate biodiversity finance to financial decision making to allow us to fundamentally rethink our relationship with nature and transform our economic models and market systems. And we know that kind of from a overall economic system, it's necessary, but the question is in many ways how to. And kind of this why not and how to are of course closely related. And this is in some ways a very basic study, because the biodiversity finance world is, I think, emerging very quickly, but we're also need to wrap our head around different things that we did not look at before, also which are different from the mainstream green finance, which is of course often climate finance. There are some important differences. Now, the way I look at it is very clear, kind of what is driving financial decision making. And there are these three clear factors that drive financial decision making: is my revenues, the cost, and the future earnings potential, or the future earnings and risk, future earnings and cost potential, which is in many ways the risk. The risk is telling me what's happening in the future, or how likely it is to happen in the future. And how is it related to biodiversity in the financial decision making? Now, I kind of looked very much at the literature. There's so much literature out there kind of on basic finance, and applied this literature and these concepts from the literature to biodiversity finance. And that is ideally, of course, the result, closing the gap, and we have hopefully some biodiversity finance principles. Now, the first question is, of course, revenue generation. And the hypothesis is pretty simple. There is no possibility to capitalize on nature positive investments. And I think that's one of the challenges if we want to move to biodiversity positive investments, is to create a possibility to capitalize on nature positive investments. Now, what is very clear in kind of biodiversity nature, that the beneficiaries of positive externalities. So kind of as an investor, I'm investing in reforestation, and at the same time, I'm creating a lot of insects that are good for the farmer down the road, because it pollinates his plants. The beneficiaries of these positive externalities, however, are often undefined. And there's a number of reasons for that. Most importantly, property rights are undefined. So particularly nature often does not, of course, belong to any particular investor who will capitalize on it. So the beneficiaries of the positive externalities are very clearly undefined. Now, even if the beneficiaries would be defined, they're often very dispersed, which of course we are all very familiar with the free rider problem. So the beneficiaries would not want to pay for the positive externalities that another investor creates, because either they're badly organized, or it's very hard to collect them because they're very dispersed. So there's obviously a strong free rider problem that makes it very hard to capitalize on these positive externalities. Now, there have also been a number of concepts developed in order to benefit from nature positive investments. There's payment for ecosystem services. So far, the use of that is very, very little. There are, of course, great case studies, and we like to use these case studies time and again, that somewhere up the river, the water is being cleaned through a nature-based solution, and then down the river, New York benefits from clean water and doesn't have to clean the water itself very expensively. And so it's obviously a win-win situation. This is a payment for ecosystem service. Now, the question is, of course, still that we don't know often the external beneficiaries. And so the payment for ecosystem service is still extremely little use. Biodiversity offsets is another way to benefit from this nature positive externalities. However, similarly to carbon offsets, it is extremely difficult to actually use them, to actually apply them. And then there's also often a challenge of additionality. So if you want to have nature positive investments, it's not that we can destroy nature on one side and then say we are offsetting it on the other side. There is no nature positive in this case. Now, the final one is nature climate solutions, and so far there is, of course, broad application lacking. I think there's much potential in there because we're definitely seeing more money flowing into the climate protection. I will come to that in one of the solutions. Now, the second part is, after the revenues, is the cost. How do we internalize the cost of nature's loss? So even kind of to stop the bleeding of nature. Again, the question of ownership, who owns nature? So if there's no owners, who sets the price for the destruction of nature, or even whom to pay for nature's loss? So this is there's clear question of ownership, and this has been studied well. This has been a recurring problem. So there's the idea of creating this common good of public order, or to define nature as common good for public order. That does nevertheless not really help who to pay for the nature. Now, there are, of course, kind of then the principles in it. Like, okay, if we destroy nature and we can pay for it, or there is this concept of the tragedy of the commons, which is, of course, well established. The benefits of exploiting nature are internalized. I have a sheep and I'm grazing it, and I'm destroying the pasture, while at the same time I'm benefiting from having more sheep, but all the other shepherds might actually lose out. So the cost of nature's destruction is socialized. Now, Coase theorem then says we have a potential to price this. The Coase theorem says kind of if two actors come together and one actor destroys nature, the idea is that the loss of the nature for the one actor might be lower than the gains of the destroyer, and therefore the benefits can be shared, and you can find a optimal solution between those two actors. So that's a reciprocal satisfaction between the two actors. Now, of course, also from a nature, even nature, reducing the nature's loss, it is extremely difficult to apply this Coase theorem in practice. Again, we don't have property rights for a lot of the destroyed nature. And we also do not reduce the destruction of nature. So we're still destroying the nature by applying this Coase theorem. So we don't have a way to really evaluate the cost either for investors. Now, I give you here an example of the internalizing cost example under the Coase theorem. We have this shepherd that uses or kind of whose sheep are putting a lot of excrements, pee and poop into the waters around it. And so the fisher who usually fishes in the waters might, of course, be affected. His catch will be lower. So can the Coase theorem be applied? Potentially, just kind of from a cost perspective, yes, if the fishers actually would be organized, but often they're not, and would have clear property rights that can be defined. Otherwise, who gives them the right to fish there? So it's kind of this, particularly for indigenous peoples, this is extremely challenging. The farmer around who also might see his crop yield go down because the water is not as clear anymore. Here, I think the Coase theorem, from an economic perspective at least, could be applied because the impacts could be clearly evaluated. And the third stakeholder group would be the public, who benefits from drinking water, from clean drinking water, which gets destroyed by the grazing sheep. And so the Coase theorem in this case is, of course, not applicable because previously we had free water, free drinking water, and now it's just not there anymore. It's not that I'm accepting money to suddenly drink dirty water. So the applied solutions here are that the government sets tax for pollution. Again, this might increase the cost of nature's destruction for in this case, the shepherd or anyone else, but it might not stop the actually this destruction of nature. And it's also extremely difficult for the government to fairly redistribute the tax. The second aspect is that the shepherd cleans the water, and so to say internalizes the cost. But again, it's very difficult to implement that because it would require really strong external benefits or pressures onto the shepherd, such as reduced litigation risks, so a strong legal system, or economic gains, either through CSR benefits or other gains. And the third one, the third solution, again, to internalize the cost and stop polluting the water, is that the shepherd would charge for the clean water. So again, this ecosystem service provision. Under this, I would internalize the cost of the destruction of water. I would clean it up again. And then I would want to charge it as kind of the shepherd. But in this case, the overall economic welfare would decrease because suddenly the fisher, the farmer, and the public who previously benefited from that water might actually have to pay more, and the overall welfare might be reduced. So it's extremely difficult kind of to internalize the cost properly. Now, the third aspect is the risk evaluation and kind of understanding future earnings and costs. And we have here 4 different utility curves kind of that show us the future investment and return potentials. And we have different types of utilities. We have the increasing utility, for example. I think an obvious one is software. We invest a little bit and in the future we're getting more. The linear utility, the decreasing utility, the nature's utility. And here kind of we are investing, utilizing it. And the nature's utility is unfortunately a threshold utility. We don't know exactly when the ecosystems collapse. We just know that most likely ecosystems collapse because we've seen ecosystems collapse, but it's unclear at what point in the future the ecosystems will collapse, which makes the risk evaluation of these investments extremely difficult. Also, kind of not only do we not know where the threshold is, we also don't know how to measure it. So measurement on biodiversity impacts are currently undefined. It's one of the reasons why the TNFD, the IRIS+, the SDPI are all currently trying to find ideas how to move forward. This is because biodiversity impacts measurements are complex and without a singular metric. Now, it's a little bit different from climate change at the beginning. Climate change has a clear measurement scope by now. It's kind of scope 1, 2, 3, and we have CO2 equivalent. We don't have anything similar to understand the measurement of biodiversity risks. Now, kind of also the question is on the impact on nature and the dependency on nature, this double or single materiality in biodiversity. So we also don't have a framework there. So it's also very different to climate, where the TCFD provides a framework to measure the risks onto the company, and ETS and ESG tools provide at least kind of a tool to measure the emissions. And then there's of course lack of data. At least we believe that there is a lack of data, which makes even if we would have a measurement, the reporting. Kind of if you would have a measurement framework, it would still make the measurement itself extremely difficult. So that's why the risk is extremely difficult. Now I have a couple more minutes. So kind of the research is very clear. There is no scalable solutions to create revenues that allow us to internalize the positive externalities, while at the same time, it's very cheap to externalize negative externalities. So the next negative externalities are way too cheap. And the risks are clearly unknown, kind of what is actually the future revenue and cost potential or also non-potential. So that's kind of the overall finding. That's kind of, I think in some ways it's similar to what Florian just described before. It's kind of, there's a willingness to pay if it kind of gives you a glow, a warm glow, or a green glow, or whatever you want to call it. But the economics behind it are extremely difficult, and even more so difficult in the biodiversity finance space. And then there's all this kind of talk about, oh, we have to mobilize in mainstream green finance, particularly by the NGOs and some of the regulators. Now, kind of coming from this literature and kind of coming also from some a lot of discussions with the with financial sector and NGOs, it's very clear we have to stop the nature negative and move to nature positive, which is extremely difficult. But from the literature, I think kind of there are 4 principles that can be derived. Number one, it's very clear that kind of under the circumstances that we don't have clear property rights, that we also should make clear that not all nature is bankable. Sometimes in the finance world, we like to make everything bankable, but of course, not all nature is bankable. I think it's quite obvious. Nevertheless, it's extremely important to always have this principle at hand. So investments need to be externally limited. Also, Florian said kind of the regulation is important to steer it. Now that's kind of really to stop the bleeding. The second, and that's, I think, kind of particularly for the risk management framework, extremely important. We need to focus on measuring local risks. This is also very different from the climate finance world, where any CO2 emissions anywhere, let's say in Germany, impacts the risk of flooding also in Australia. This is often kind of the direct risks are very different in biodiversity. They are much more local. Both the impacts and the dependencies tend to be much more local. There are interdependencies. This is very clear, but particularly for the first stage where the interdependencies are not understood and are extremely difficult to measure, don't use this as an excuse not to measure it. So really focus on the local risk, and that's kind of what we can do. Ideally, of course, nevertheless, through more common standards, land use change would be one of those. And then increase biodiversity finance opportunities to really move to the nature positive side. And this is particularly the integration with green and climate finance, particularly nature climate solutions, where we're seeing more opportunities, particularly since we know how to value the climate risk, since we know how to price CO2 emissions much better, and therefore kind of piggybacking on the climate finance space can be actually also used for nature positive. And finally, and this is extremely important, also a message, please, for all of us, we have to move kind of from the financing for biodiversity, which is what all the NGOs are saying. We need financing for biodiversity. We need to close the financing for biodiversity gap. We need to move to biodiversity finance to include biodiversity into the decision-making process of the financial sector. For that, we need to utilize financial sector leaders, which so far we have also not really achieved. It's mostly coming from the NGOs, which is different again from the climate space, where Mark Carney and Bloomberg actually drove a lot of the TCFD. We don't see the financial sector at this time taking the same role. So I think with that, I'm ending here because I'm also running out of time, but I'm also looking forward to your questions. Thank you.
Yeah, thanks, Christoph. So far, I think we have no question from the audience, if I can see that correctly. Okay, Christoph, so I may raise a question. So in one of your last slides, you were talking about the measuring of local risk, which I think is very important. So during your analysis, what differences did you see, between, let's say, countries now? So if it goes down to local risk, is there any you would, have in mind when you talk about local risks, and are there some differences you already saw?
So I think kind of, again, the question on the local risk is the dependency on nature and kind of understanding what local changes are happening for my production on what impacts on the asset it has, and at the same time, of course, the impacts on nature that a project might have. So the impacts of the project on nature, I think, are more easy to measure so far, because we can measure land use change. It's quite obvious. We can measure also the emissions into rivers and into the soil, kind of from a pollution perspective. But again, most importantly at this time, it seems to be that land use change is driving a lot of the biodiversity loss, of course. The dependency on nature, I think that's again where we have to develop a lot more frameworks. I think this is kind of exactly what we're trying to do right now, also to understand for the different financial assets that we're having, or for the assets, it's not financial assets, for the assets, to understand what type of specific risks they have if the bees are gone, if the rivers are not having enough nutrients for the fish anymore, and so on. So this is extremely challenging, particularly on the risk of nature loss on the companies, the dependency on nature. We're really struggling.
Yeah,
I mean
that adds to that adds to the discussion that you know, taking nature into account as a stakeholder. But we received a question here in the online system. So do you see question 4, Christoph?
Yeah, it's despite all you said, do you still believe that finance has a role to play? Is it not the role of governments to change business practices towards biodiversity through regulation? So I think finance has a huge role to play. It is, of course, an understanding of the risk. So the regulator can stipulate that the financial sector has to evaluate this risk. They have to kind of, right now we're talking the finance space, that the regulator requires the application of the TCFD, at least to understand the risk that financial institutions or also corporations are exposed to. Now this is a regulator that demands it. And we needed something similar, of course, for the biodiversity sector. Just voluntary standards on reporting and understanding the risk is insufficient. So this is, it's not just, you're not allowed to do or invest here or do any projects there. It's also about the transparency, the disclosure, and the standards that the regulators need to set for the financial sector. And then, of course, we also need, and we discussed this in the side event where BNP Paribas was very clearly saying, it's like, it is extremely important that we are aware of how much value is at risk, because this is also defining our investment decision. We have a self-interest to preserve our values that we have invested in for the future. So the financial sector, if they don't know, they won't act. So kind of the financial sector needs to be informed, and this is kind of what I mean with the last part. We need to mobilize financial sector champions to understand really and to drive this this change also from within the financial sector, because their values are at risk. So it's not just government. Of course, the financial sector has an extremely important role to play there.
Yeah. All right, there's another question for you, Christoph. Looks like a research agenda.
In terms of the measurement of local risk, is there any touchable research topics you can do as PhD students, as this means that this topic is a huge project? I couldn't agree more. I think kind of what we're doing, particularly in the TNFD, is to try to develop some of these frameworks, and the measurement of local risks is kind of the two things. First of all, again, the dependency and the impact on these are two different streams of research that you can look at. The land use change is, of course, one of the things which are also having different impacts in different countries, because again, some nature is more productive than others. It's not that it's more worth than others, but it's more productive than others. And so there will be different value derived from different land use change in different countries. Seems also Chiara has a question.
Yeah. If I may, I was wondering, what would you think? Because I mean, you mentioned already that land use, it's probably one of the main drivers of biodiversity loss. But what would you think if, like, the policy agenda in a way prioritize one dimension only? Let's say only for now we only look at the impact of land use change on biodiversity, and once this is understood, then we move to water, and then like basically the question is, how much do you think that the different drivers influence each other, and how much it could be studied separately, since it's such a complex and big topic?
I think kind of in some ways, Simon Sadek made a very positive statement on our side event panel on Wednesday. He said, and I also believe that we have learned a lot from the climate finance agenda, kind of how to mobilize, how to understand risk, how to evaluate risks. We also started from a very low point in doing that 10 years ago. And the speed at which the biodiversity finance risk management frameworks have evolved, and also the understanding of the NGFS now, kind of including the central banking system, there's a lot more dynamic behind it. So I would not say that we should limit ourselves right now But if we want to focus on something, definitely the food system, and which is one of the main drivers for land use change, is of course one of the big open questions. How do we handle the future of the food system, where we are consuming more and more calories, which are unfortunately also too much animal protein, and how to deal with that in the future, and how to also regulate it, and how the financial sector might be impacted by that. So it's land use change is definitely a big topic, but I do hope that we can also touch upon other topics like soil quality, like the water, faster than that.
Yeah, because maybe I'm not aware of that, but like I'm missing kind of a background study which shows which kind of pressure are more relevant and which are less. I don't know, maybe I just don't know, but like I'm not aware of a study which evaluates that, and I think that would be super relevant for any policy recommendation.
I think this is kind of exactly where we are right now. We have all, this is kind of what I mean. We have all the NGOs and all the biodiversity specialists who've been have been talking about this actually for decades. It's not something that they haven't talked about, but it's kind of the perception is that these are the Birkenstock wearing, long-haired people, whereas the bankers are the ones in the suits, and why would we talk with each other? And it's not a joke. This is exactly what I heard from the financial industry and from the regulators, interestingly. It's like, these biodiversity people, they are so, and so we have the knowledge. It is not that we don't have the knowledge on the biodiversity risks on the ecosystems. It's just kind of that there's no, that the linkage, that we have to be much better at making the linkage. And yeah, okay, I'm also running out of time.
Yeah, thank you so much, Christoph. So
thank you.
The next paper, our third paper here in the session, is climate risk adjusted refinancing operations. And the paper is written by Chiara, Colesanti, Senni, and Florian Böser. And Chiara is presenting today. So Chiara, the floor is yours.
Yeah, thank you very much. We'll start sharing. Okay, so yeah, thank you very much for the introduction, Kerstin. And today I will present, as you said, my work on climate risk adjusted refinancing operation, which in short is called CARO. And first of all, let me mention that this is a joint work with Florian Böser, who was a colleague of mine during the PhD at ETH Zurich. And with this paper, we want to show one possible way for central banks to contribute to the transition to a low carbon economy. But as you will see, this is a general framework. So for instance, this could also work for biodiversity, as we just heard. So climate risk, both physical and transition, but also to a broader extent, other environmental risks are a source of financial risk. And several financial supervisors and central bankers have argued that markets do not price climate risk appropriately yet, which would imply that we are in the presence of a market failure. Such a market failure could arise from several issues, such as lack of knowledge, barriers to information acquisition, or horizon misalignment. And because of that, many proposals for a green monetary policy have already been advanced. We have heard, for instance, green quantitative easing, green collateral frameworks, or green reserve requirements. However, I think that it is important to keep in mind that talking about green and brown does not necessarily mean also to address climate risk exposure. So the proposition that we develop in our paper is for central banks to introduce climate risk adjusted refinancing operations. And in particular, in our model, we describe the functioning of this type of operation focusing on climate risk. But as I said, this is just an example. So the mechanism is as follows. The central bank prices liquidity provision to banks, depending on the bank's portfolio exposure to climate risk, which implies that investments with high exposure lead to higher liquidity costs. This in turn implies that the policy, the CAROs, generate incentive for banks to invest into less climate risk exposed assets. In our paper, we focus on environments where the government sector, which includes the central bank and private agents, disagree about the transition risk, meaning that they disagree about the likelihood of a transition to a low carbon taking place, which means the introduction or not of new environmental regulation, for instance. And this implies that for a central bank perspective, without its intervention, the resources in the economy are misallocated. So with our work, we aim at answering multiple research questions. The most important one are what is the effect of differing beliefs of the government and of private agents on the allocation of resources in the economy? And the second one is what is the optimal monetary policy in the presence of these belief differences? Also, as an extension, we look at how the optimal monetary policy is impacted by investment into climate risk mitigation technologies, and which role do financial stability concerns play in the decision making of the central bank. So to answer our research question, we develop a static model in which the economy is populated by households, firms, banks, and a central bank. There are two goods, capital and consumption goods, and households and firms are pretty standard. So households are endowed with the capital and consume, and firms use the capital goods to produce the consumption goods. But why do we need banks in our model? So the assumption is that firms can only obtain financing from banks. And to justify this assumption, we introduce a friction, which is that firms are affected by moral hazard. That means that they cannot commit to repay the capital goods, and they could just run away with the capital. And since only banks have the technology to monitor firms and to eliminate the moral hazard, they are the only one financing firms. For simplicity, we focus on the case in which banks can ensure full repayment and the monitoring costs are zero. Why do we need a central bank? In our setting, banks are funded with equity and deposits, which are the only medium of exchange in the economy. So deposits flow among banks due to transactions among agents in the economy, and this leads to interbank liabilities, which have to be settled at the central bank with reserves. So banks need to borrow liquidity from the central bank to settle these transactions, and that's why we need the central bank in our model. So as I said, households are pretty standard, and we focus on a representative household, which sells its capital goods endowment to firms. And as we focus on a monetary economy, the revenue from selling the capital goods take the form of deposits, which can be invested into bank equity or be held as deposits. And the two assets could yield a different return. Also, we assume that households have a linear utility in consumption, which means that for portfolio allocation, only expected return matter, and the household just invests all his funds in the assets which yield the highest expected rates of return. Moving now to firms, we model two representative firms, namely riskless firms, denoted by L, and risky firms. So the first one are not exposed to climate risk, and the second are. We focus on transition risk, as I said, which is represented by the introduction of stricter environmental regulation. And depending on the happening of the transition or not, two scenarios can be distinguished. So the business as usual with no new environmental regulation, and the transition scenario, which is denoted by T, and where new regulation might be introduced. Both type of firms in our model produce with concave technologies. AL is the deterministic total factor productivity of riskless firms, and AH is instead the total factor productivity of risky firms, which depends on the scenario that realized. And the assumption that we do is that the productivity of risky firm is higher if the transition does not realize, so in the business as usual, and is lower if the transition realizes. So as I mentioned before, firms are penniless, meaning that they demand loans from banks to purchase the capital goods that they need for production. And then they use the revenues from selling the consumption goods to repay loans to banks. Loan repayment is deterministic for riskless firms and stochastic for risky firms. Also, the two types of firms choose the optimal level of capital given their production function and their liability to banks. Again, to simplify the assumption, the analysis, we assume that in each scenario, the marginal return of production equals the repayment obligation per unit of the capital good. This means that in the case of risky firms, they pay a high interest rate in the business as usual scenario and a low interest rate if the transition occurs. So the central bank, so as I mentioned before, banks borrow reserves from the central bank to settle interbank liabilities. And these reserves can be deposited at the central bank where they are credited with the interest rate RDCB. Since we focus on a representative bank, reserve deposits must equal reserve loans. And reserve loans are subject to repayment costs, which are determined by the loan rate RLTB. So this loan rate depends on zeta, which is the share of loans that banks grant to riskless firms, and on kappa L and kappa H, which are the cost factors associated with bank loans granted to riskless and risky firms, respectively. So note that this equation is really the core aspect of our model because it implies that the central bank applies a differentiated interest rate depending on the exposure to climate risk of banks' portfolio. Also, we impose a constraint, and the constraint is that the loan rate on reserve is larger than the deposit rate on reserve, meaning that liquidity is generally costly for banks. So the central bank maximizes expected welfare, and it maximizes welfare under its belief about the transition, which are denoted by the probability eta G. However, we don't model the decision about the transition, which is probabilistic and external to our model. So basically, the central bank chooses the interest rates on reserve deposits and the cost factors to maximize welfare without knowing which scenario will realize, and under the constraint of costly reserve borrowing. So the representative bank instead grants loans to riskless and risky firms, and it's funded with equity and deposits, which are given by the total amount of loans minus equity. And the demand for reserve right banks is determined by the share of deposit outflowing in each period. That is by the need to settle interbank liabilities. Finally, for the bank, loan repayment is risky because of risky firms, and banks share their beliefs about the occurrence of the transition with the other private agents in the economy. And these beliefs are captured by eta P. So while the central bank maximizes welfare, banks maximizes the expected shareholder values, and they do that by choosing the loan allocation across the two sectors. In equilibrium, this implies that the loan pricing is such that the difference in interest rates between the two sectors is determined by the difference in the cost factors. In particular, riskless firms face a lower loan rate compared to risky firms if the liquidity cost factor applied to risky loans exceeds the one applied to riskless loans. The loan allocation is also influenced by bank beliefs. Indeed, the less bank believe that the transition will occur, the more loans are allocated to risky firms because banks attach a low probability to the low return that would occur if the transition actually takes place. So from this result, it's already clear that the central bank can counteract the belief-driven effect on the loan allocation by setting the appropriate liquidity cost factor. So the central bank can, in a way, steer resources towards less climate risk exposed sectors. So just briefly, some additional equilibrium properties. What we find is that if using the link between loan rates and productivity obtained by the first order condition of firms, the loans or capital allocation to the riskless sector depends on relative expected productivities in the two sectors and on the cost factors applied by the central bank. So you can see that the expected productivity of risky firms, and thus the relative expected productivity in the two sectors, is affected by the belief of private banks about the likelihood of the transition. Specifically, the higher the probability eta p that private agents attach to the transition, the lower the expected productivity of risky firms, and thus the higher the share of capital allocated to riskless firms. Similarly, a larger cost factor applied by the central bank to loans to risky firm increases the share of capital allocated to riskless firms. Also, in equilibrium, aggregate welfare depends on the scenario that realizes and the neutrality of money holds, meaning that the interest rate applied on reserve deposits is irrelevant for the real allocation. So let me now move to the optimal monetary policy. So the central bank uses its interest rate policy on reserve, which is determined by the cost factor kappa L and kappa H, to induce the capital allocation in the economy that would emerge without bank intervention, but if agents would share the beliefs of the government about the likelihood of the transition. So in other words, the central bank corrects for the belief differences between private agents and the government. In this expression A, the ratio A captures the ratio of expected productivities under private and central bank beliefs. And as you can see, if the central bank attaches a larger probability to the transition taking place than what private agents do, then the ratio A is larger than 1, and the central bank will charge a higher cost factor for loans to risky firms. On the other hand, if the government and the private sector share the same beliefs, then the ratio is equal to 1, and the central bank does not need to intervene because just set the cost factor equal to each other. As a corollary to the optimal monetary policy, we find that the difference between the optimal cost factor increases with the beliefs of the government sector and decreases with the beliefs of private agents. Indeed, if we define the intensity of central bank intervention as the absolute value of the difference between the two cost factors, then if, for example, private agents underestimate the likelihood of the transition compared to the government sector, then the cost factor applied to risky loans is larger than the one applied to riskless loans. And exactly this shows that the intensity of central bank intervention increases with eta G and decreases with eta P. So let me now move to the extension to our benchmark. I will not go in detail here, but just give you an insight of our results. So in the first extension, we foresee the possibility for firms in the risky sector to adopt climate risk mitigation technologies, which reduce their exposure to climate risk. Specifically, a risky firm can decide to devote a share I of their capital to invest into climate risk mitigation technologies. And the assumption is that these investments increase the productivity of risky firms if the transition realizes and have no impact in the business of user scenario. The possibility to invest into climate risk mitigation technology clearly affects the optimization problem of firms, but actually not only. It also influences the optimal monetary policy, because now the parameter A depends on the share of capital invested. In particular, you can see that if the central bank attaches a larger likelihood to the transition compared to private sector, then the policy parameter decreases with the share of capital invested into climate risk mitigation technologies. And so investments on the side of firms always reduce the intensity of central bank intervention. This basically means that fiscal and monetary policy can support each other in the transition to a low carbon economy. So the second and last extension that I will present today includes bank recapitalization, which represent a proxy for financial stability and can also depend on the beliefs of agents. So as we have already seen, banking operations are generally risky because loan repayment is uncertain because of risky firms, but the costs arising from interest payment on deposits and from reserve borrowing at the central bank are instead deterministic. Also, since we assume that banks operate under unlimited liability, the households, which is the only shareholder of the banks in our model, may be required to inject new equity whenever the initial equity gets wiped out. So this was also the case in our baseline model, but there we assume that bank recapitalization was frictionless. And in this extension, instead, new equity injections lead to additional welfare costs, which depends, for instance, on negotiation and organization of the new injection with the shareholders. Now, what's different from before is that when the central bank chooses the monetary policy, it faces two externalities, which depends on private agent beliefs. So first, from a central bank perspective, beliefs of private agents leads to a distortion of the capital allocation, as we have seen also before. But now, additionally, private agents' beliefs can trigger bank recapitalization and reduce welfare by inducing costly equity injections. Also, what we show is that the central bank usually faces a trade-off between correcting the one externality or the other, so the loan allocation or the ruling out of financial instability. So to conclude, in our work, we show that CAROs are effective in correcting a climate risk-related misallocation in the economy, and that they can shift resources towards less climate risk-exposed sectors. From a central bank perspective, without its intervention, the different beliefs of private agents led to a misallocation in the economy, and that we are showing in the baseline model. But by using the appropriate liquidity cost factors, the central bank can induce the allocation which is optimal under its beliefs. And in the extension, we also studied the role of investment into climate risk mitigation technologies and outline the optimal monetary policy in the presence of financial stability concerns. Obviously, many research questions remain open. For instance, what is the effect of CAROs on inflation, or how they interact with other financing sources, or how they could impact investment into climate risk mitigation technologies. Not only, there are also implementation questions that remain open. For instance, how do CAROs fit into central bank mandates? What are their costs? What is the data available for their implementation? And how to deal with the risk of regulatory arbitrage or greenwashing. Thank you very much for your attention.
All right, Chiara, thank you so much for your presentation. So up to right now, there are no questions from the audience here, as I can see. Okay, so Chiara, you mentioned in the beginning, if I got it correctly, that your idea is to adapt it to other areas, also to biodiversity. Did you try that already, or?
No, unfortunately not, but that would be for sure very interesting. I think, as Christoph also made very clear earlier, one would need to introduce an additional dimension, which is this local specificity, which is not needed when designing this policy for climate. But yeah, also the big issue behind the implementation is that I don't have access to any data to somehow quantify the effect, and I would leave it as a theoretical model for now.
Of course. Okay, it looks like, yeah, there are no questions from the audience. And as far as I can see, also not from our end. So is there something? Oh, Christoph, yeah, okay, sure.
So from a practical policy perspective, Chiara, kind of what would you see kind of as the necessary steps for a central bank to think about applying such CAROs?
I mean, for sure, the need for good metrics, somehow distinguish between climate risk exposed and not climate risk exposed sectors. It's very difficult for now, only be very arbitrary. I mean, there are some classification, of course, of sectors, but I think if these measures would rely on more appropriate climate risk metrics, that would be very helpful. And for the implementation, I think, I mean, there are some, I think there have been already implemented some measures which are somehow similar, like if you think about refinancing operation targeted SMEs, this is anyway taking a position on which segment of the economy you want to support. So I think there are some precedents which could be used for that, but in general, I think that an evaluation of the potential impacts would be very much needed to favor the implementation. Or if I answered your question.
I think so. So, Chiara, there is a question now from the audience. Can you see that?
Yeah. Would there be a way to make central bank policy not? Yes. So the question is whether one could basically, if I understood correctly, overcome this trade-off between correcting for capital allocation and financial instability. And I mean, in terms of the model, that would require to relax the constraint on the optimization of the central bank, that reserves are costly. So basically, the central bank could overcome the constraint if it try to, or like if it induces the optimal capital allocation, and at the same time, whenever banks face losses or needs recapitalization, it allows banks to make profits by borrowing reserve from banks. Of course, this would mean that banks would require an infinite amount of reserve, which would require a threshold on the maximum amount of reserve that could be borrowed. But yes, through this mechanism, like allowing this profitable reserve borrowing, then one could obtain both like no financial instability and correct capital allocation.
All right, thank you so much. So it's now up to me to closing the session on time. So I would like to thank Chiara, Christoph and Florian for their presentations, and also the audience for listening. And I hope to see you all at the closing session, and hope you enjoy the rest. So I get here, I'm going to put on the following slide soon. Yes, okay, it's already mentioned over here. All right, guys, thank you so much again, and see you all a little bit later.
Thanks a lot.
Thanks a lot. Bye.
Thank you, everyone. Bye.